How we doing? How we doing? Today is Thursday, March the 7th, 2024. I'm just doing a video here in regards to real estate notes and seller financing. The pros and cons of seller financing is specifically what we're going to be going over. You see my contact information there. Each Thursday, we do this at 8 p.m. Eastern Standard Time. If you can catch the replay if you're not here live. You can catch the replay at my YouTube channel, Abundant Capital Group. Go there. There's a playlist that says Real Estate Notes and Seller Financing 2025, and you'll see all the videos in the series there. This is, I think, the third or the fourth in the series. So we're just kind of going through this methodically. We're gonna, go through seller financing. We're gonna go through real estate notes, how you can invest in real estate notes. We'll kind of get to that sometime down the road. But just wanted to kind of show people the pros and cons of seller financing. If you don't know what seller financing is, you can go back and watch one of the videos. Really quickly, it's just when the person who is selling the property actually finances the property for the buyer. So we're going to go over 10 pros for seller financing. The first one is shorter marketing times. Um, Homes that market themselves as owner will finance on an average sell at least 20% faster. So, it boosts how fast you can get the property sold once you do offer owner will finance. The reason that is because of probably point number two is that there are more buyers. 30 to 50% of people who try to get qualified for a loan, conventional financing, don't qualify. So that doesn't mean that they're not able to afford a house or be a homeowner. They could have something, small on their credit, had an issue relatively short amount of time ago. There could be a number of reasons. They could be self-employed and have multiple properties, and a bank will not approve them. But if you look at any type of statistics on, the percentage of people who get declined for a mortgage, not all of them are in a position where they couldn't afford to be a homeowner. So, you open up the pool of buyers to people who didn't get qualified in a traditional sense from a lender. You can, possibly sell them your house and do the seller financing with them. You get speedy closings. You can close within about 2 to 3 weeks. There's a lot less red tape when it comes to seller financing. You're not dealing with the banks. You're not dealing with, all of the files that they have to deal with and kind of get through and get prepared for closing. So you can do this fairly quickly. And that could be good depending on the seller situation. Maybe they don't want to wait 60 days to kind of get or 45 days for a transaction to close. You can, get this wrapped up usually within 30 days or less. Um, you can maximize the selling price. You have to think of seller financing as an amenity, and that probably plays into the reason why it sells 20% faster. It's like saying a seller will give a seller's concession. I don't know if you've seen that or not on a listing, but sometimes, things like that will show up on a listing and make a home more attractive. And um, when you offer seller financing, you can sell your house at a premium because you are offering this amenity. Anywhere from 5 to 10% is kind of average. So if the house is valued at 100,000, you probably can sell it for 110,000. Uh, you don't want to go too far above. I mean, you could go to 120, 150,000, but typically, usually stay within that 5 to 10% range. The reason why you don't go too high is because if you do want to sell your note, the seller financing that you created, if you want to sell that later on, It's going to be based on the value of the property. So if you overvalue it by a lot, you're not going to get the price that maybe you want for that note on the unpaid balance that's left. So, and this is also an option instead of lowering your purchase price. So if realtors see this, if you are a seller and you're listing your house right now, I would talk to my agent about seller financing. See if they heard about that. See if they are familiar with it, and see if it could work in your favor as opposed to lowering your price. You can keep it at the price that it is and say, let's see if we can sell this with seller financing. So we don't have to take that price reduction. You have reduced restrictions on credit. A lot of times, people with maybe below average credit can still get into a home. But the average is about over 620. I think the average national credit score for people who buy seller finance homes is above 620. But sometimes you get people that are below that, maybe in the high fives. And so again, that could be a reason why they're not getting qualified for a bank. But they have the income, they may have had some type of hiccup and not fixed it on their credit. And we can still work with them and get them into a property. Source of the down payment. A lot of times banks or lending institutions, if you have to put down 10% or 15%, whatever it is for a property, they want to know where that money came from. You can't just go and ask someone, for 10 or $15,000, something like that, and it just shows up in your account. A lot of times they look at that, they frown upon that. They want to see that it was sourced maybe from you selling a stock or an investment or something like that, where you can then get the money, or if you saved it up. But when it comes to seller financing, we're not interested in that. If you got the money to put down on the property, that's fine. Your source of income, a lot of times, again, we're living in different times right now where people they make money from podcasting, they make money from YouTube, they make money from gig type work. Working multiple situations. Sometimes, banks look at that and say, well, they don't have a steady, 9 to 5 job. They're kind of getting money from all over these places. We don't know how stable that is. That could be another reason why the person is not getting qualified. So we don't have those same restrictions. Um, Fewer costs in terms of origination fees. We do not charge points when we work with the buyer and the seller to set up the seller financing situation. There are no points that are charged. A lot of times, if you don't put down 20%, lenders will charge you PMI, which is mortgage insurance, meaning that it could add an additional $100 to $300 extra to your monthly bill because of that insurance. That insurance stays in place until you have built up at least 20% equity. Then they can take it off, and that's just to protect their investment in case you do default. They have this insurance policy that will pay for the loan. No junk fees. Large portions of the funds go to building equity as opposed to some of these fees, paying all of these closing costs and things of that nature. Um, you may put down $20,000, but then, maybe only 13 or 15,000 of it actually gets credited towards a down payment and goes into equity, while the rest of it goes to a bunch of fees and different things like that. So those fewer costs come in handy for a buyer. Interest income. Seller can sell the property for 2 to 3 times more depending on the interest rate and the term. So if you're someone, you have, let's say, $200,000 worth of equity, but you don't have a specific need, or something to do with the all of the $200,000 that you get from a sale. What you can do is get a certain portion of your equity and then do the seller financing. And because you're charging interest on your buyer, your money is gaining interest over time. So down the line, this house could be, sold at two, three, four times as much, depending on what the market is, at that particular time. But you can essentially, get more money, down the line when you do maybe want to cash in on the unpaid balance that's remaining on the property, or if somebody sells the property while you are seller financing it to them, they have the ability to kind of put it on the market. Maybe it goes up, and then you get a lump sum later on. And then when you look at your down payment, you look at all the payments that you've collected over the months, plus the lump sum, you'll see that, I might have, tried to sell it and get the 200,000, but 7 years later, I got 250,000. Once I add up all the payments that I received, my down payment, and then the lump sum. And so we'll, kind of show that at another time because we'll get into amortization schedules and things like that. But earning the interest income over time allows you to make more for the property. And again, if you're in a situation where you're selling your property, but all of the equity you don't need right now to go and do something, you want to consider doing seller financing. Installment sale. This could help you delay capital gains taxes. The IRS publication 537, section 6252. I would speak to your financial advisor or somebody that helps you with your finances, an accountant, somebody like that, your tax person about the installment sale. This is a strategy that will help you when it comes to the capital gains taxes and help you, with that and maybe getting that spread out over time and reducing the capital gains tax by doing an installment sale. You have the secure of the asset because you always have the property. So if anything goes wrong, you can get that property back at any particular time, and then you can try and just go sell it at that particular time. Maybe it's a really hot market and you can just go sell it, or you can get it back and do this again. Collect another large down payment, start collecting, monthly payments again, and then be owed a lump sum down the line. So this is a liquid asset. Um, you have the ability, let's say you do this today, or let's say you do this at, next month, you sell or finance the property, and then in 5 years from now, your situation changes. Maybe there is an investment that you want to do. There is a wedding that you want to pay for. There's a kid that now is going to college, and you want to be able to take care of some of those expenses. You can sell this note that you've created, and you can sell the whole note or you can sell a portion of it. Let's just say in 5 years, you only need $25,000 to maybe go on a dream vacation. You can sell a certain amount of payments of the unpaid balance for that $25,000, and then you're still in the deal, so to speak, because you're selling a certain portion. You may sell 100 payments of the remaining 200 payments for the $25,000. So someone is going to take over and collect that monthly payment for those 100 payments. And then on payment 101, that monthly payment is going to revert back to you. So you've collected a down payment, you've collected monthly payments, you've collected another lump sum, and then you'll start to, collect monthly payments again sometime in the future or be paid off. The property could sell within that 100 months that you sold those partial payments, but you're still owed a certain amount for the remaining balance of those payments. So there's multiple ways that you can liquidate this asset. So now we'll talk about the cons. We have a few cons here. Time is money. Waiting to get paid. Again, and again, I titled this, what does it say? It says, oh, I gotta go back. Uh, Oh, uh, it says seven cons for seller financing, or are they? Are they really cons? Um, waiting to get paid. But maybe that's not a bad thing. Again, because you're waiting, you are making more money in the sale of this particular property. And this is for those that, like I said, you don't have to have all of your equity right now. So you're already, know that you're going to wait, for an additional lump sum down the line. So again, is that really a con? It depends on, on how you look at it. Collecting payments, tracking payments, principal interest application, the 1098 mortgage interest statements, if there are any late payments and, having to get those and follow up on that or delinquent payments, somebody, if the insurance lapses on the property, these are all things that you're responsible for. But this is why we have a third party servicing system. A third party servicer follows up on all of this stuff. That's their job. That is what they do. They make sure that the payments get collected, they get sent to you. They make sure that the statements go out. If there are late payments, they are sending out letters. They are calling. That is a part of what it is that they do, and it's really for a small fee. A lot of times, it's under $50 for these servicers. So, you know, is this really a con? If somebody's handling it, it may be a little, obviously it may cause you some problems that you're not collecting the payment if something happens with the buyer. But you have remedies to that situation and what you can do. Um, as a private investor that is creating the seller financing, you don't get to um, have the luxury of the TARP program, the Troubled Asset Relief Program, which was a $700 billion program, a bailout program created by the U.S. government in 2008 to stabilize the financial system. So if we do have some type of downturn, um, the this type of government program, you wouldn't be necessarily eligible for. But if you go back to the great financial crisis, they had a program called the hardest hit funds. So if you as a note holder had someone that was in trouble, couldn't make the payment, whatever the case may be, because of everything that was going on, there was a program that if the person wanted to stay in the house, you could, help them fill out the paperwork, and then they would pay anywhere from like 25 to $50,000 to get somebody caught up on any late payments. And sometimes they would, then pay, for the next 12 months. So, there are programs out there to help homeowners stay in their homes. And again, if we get into that type of situation where, there's a significant amount of people going into foreclosure and we're having a big issue, you can best believe that the government is going to step in with some type of program. So you're maybe not eligible for this particular program that went to, the big banks and stuff like that, but I'm pretty sure that there are going to be other resources that you'll be able to take advantage of. Who's in first position? Sometimes when you create a seller finance note on a property that you already have a mortgage on it. Let's say you have a property, but you get a new job in another state and you need to move. Um, you can still create seller financing with a lien that, with your current lien that's still on the property. So you can do that, but you want to make sure you won't be in first position in that instance because there's an underlying lien there. So, you'll be in second position or third position depending on how many liens are on the property when you purchased it. So, that that may be a little bit of a con because if anything does happen, the first position is going to get paid first, but that doesn't mean that you're not going to get paid because you still have interest in the property. There's things that you can do. If the buyer runs into trouble, you being in second position, you can, then be able to work something out with that particular buyer, maybe get the property back and then again, try to do this again, or you can sell the property. The person can sell the property and make sure that everybody gets paid off. Hopefully, there's enough equity there to pay off the first lien as well as you in the second or third position. If it's not, again, there's things that you can do to work with that particular seller, um, to work with that particular person that's in the property to make sure that you recoup your investment. And there's also a due on sale clause risk. There's a clause when you do have a mortgage in first position that says that if title changes hands, they have the right to call the whole loan due. Happens very rarely. If you ask anybody or Google any statistics on it, it's something that probably happens less than, I'd say, 10% of the time, probably more, less than 5% of the time, because banks don't want to take back the property. They want that payment coming in. So as long as the paperwork is done correctly in these types of transactions, and that's, obviously what we can help with, um, the bank will still receive their payments. There shouldn't be any issues like that. And then there are remedies if this due on sale clause comes up, and we can cover that at the appropriate time. The dreaded discount, meaning that if you create a note on a property, and how we talked about before, you want to liquidate it, many times you do take a discount. How much of a discount? It all depends. Um, so there is some type of discount off of the unpaid balance. So if you're owed $100,000 as the unpaid balance and you want to sell that note, more time, most of the time, probably close to 100% of the time, no one's going to pay you $100,000. They may pay 95,000, 90,000. Just depending on who the buyer is on the property and the situation and everything that's going on and the value of the asset at the particular time. But a lot of times they can pay a higher percentage of the unpaid balance, um, which you would be owed on it, but they will most likely will not pay the full 100%. That's what they call par in the industry. So you have to think about that there will be some discount, and again, if everything is written correctly, written properly, everything is going okay, and at the time you need to sell it, you can anticipate that being a very minimal discount. And then the last thing is those pesky laws. There's a lot of things with the CFPB, Dodd-Frank, the SAFE Act, RESPA, a lot of these laws that are in effect for when people create or originate loans on a property that you have to make sure that you're doing properly. But again, that's really not an issue because what we do is we make sure that we have an RMLO, we have a title company, we have an attorney. We make sure that all of the laws are followed accurately, all the disclosures are there. You have the professionals who do this, who prepare this paperwork. We make sure that all of that is there. But there are some things that you have to make sure are in place when you create these seller finance notes, especially for someone that's going to live in the property. And you want to make sure you do that because if there is any issues later on, nobody can come back and say, "Oh, I didn't sign this. They didn't do this disclosure. They didn't, they did not." Do enough research on if I was qualified. So that's why you want to make sure if you're going to do this, that you do it with the right people. Make sure that you're going through the proper steps so you don't have any issues later on. So those are some of the pros and the cons that we wanted to kind of go through. Again, we'll be back next Thursday, 8 p.m. Eastern Standard Time. You can check my Facebook and the Instagram for the link to the Zoom meeting if you can make it. If you can't, again, this is going to be put up on the YouTube channel. You can watch it at any time. If you watch it on YouTube, please post any comments, any questions that you may have, something that you might want covered, and we'll make sure that we get your question answered and make sure that the topic that you're looking to get covered gets covered as well. All right, everybody have a good night, and we will talk to you soon. Have a great one.